You're watching The Open here on BNN Bloomberg. I'm John Ehrlichman, and we have been watching the story of Canada's economy through the lens of inflation. Canadian consumer prices accelerated for the first time in 4 months in June, and that likely will keep the central bank, the Bank of Canada, from cutting interest rates later this month. Let's bring in Claire Fan, a senior economist with RBC Capital Markets, to get some reaction. Claire, great to have you with us. So on a day when we saw some softer inflation numbers in the U.S., we saw inflation quickening in Canada. What's going on?
Right. So the headline CPI print actually from this morning was pretty much bang on consensus. But I think if you were to look at a lot of sort of the underlying details, we are seeing very mixed signals as to sort of where inflation is heading in Canada, because data essentially is telling us that there are some early impacts that we're already seeing from tariffs that have been pushing certain categories like clothing and footwear higher. But outside of that, broadly underlying pressures are also building.
And so do you think that, with the trade uncertainty right now, because I think in the U.S., especially with the trade uncertainty, people were wondering if we'd see a quickening of the inflation story there. Is there a risk that the inflation picture is going to get more complicated if you look at the rest of the year here in Canada?
Yeah, absolutely. I think the inflation picture before we headed into this trade war was already kind of complicated because of, as we all know, the end of consumer carbon surcharges, that lower energy prices. So we're still seeing that play out. But in terms of the comparison with the United States, I would say that what we saw this very last month was, interestingly, what we call essentially a broadening out in price pressures in both countries, meaning that more and more goods and services these days in Canada as well as the U.S. are seeing higher inflationary pressures. But there's a key distinction here that I think is really, really interesting, and that has to do with the scale of tariffs that we're seeing right now as well, which is that in the United States, there are more definitive signs that tariffs are driving consumer prices higher. We're seeing it in core goods and home appliances. Versus in Canada, this is the story that we've been telling, which is that it's really consumers, Canadian consumers, that have been, showing a lot of strength, a lot of resilience in their purchases heading into the summer. And that's reflected in the inflation data as well. We see the so-called Bank of Canada core or super core measure, which is essentially a gauge for how the underlying consumer pressure induced inflation pressure is. Essentially, that's been pretty robust or resilient, still hovering above the Bank of Canada's 1% to 3% target range.
Well, it's interesting, like we were even covering some earnings over the last couple of days from MTY. They operate a lot of casual dining operations across this country and the U.S. as well. And they were noticing some pretty reasonable performance in Canada, less so in the U.S. So maybe sort of speaking to what you're saying there. The Bank of Canada Governor Tiff Macklem and officials at the BOC, they kept the policy rate at 2.75% for the past couple of meetings, and they were citing issues like what you were just highlighting there, firmer core inflation, and then, of course, the trade uncertainty. And it felt like this morning traders lowered their expectations that at the end of this month that the Bank of Canada would sort of shift away from that and say lower interest rates. And yet, we've spoken to a lot of economists that sort of, if you look through the end of the year and maybe into next year, would still anticipate a couple or a few rate cuts possibly being on the horizon. So what's your current thinking on interest rates?
So first up, our current view on sort of the overnight rate in Canada is that it's going to be maintained at the 2.75% it is today, pretty much throughout this current rate cycle. We think the Bank of Canada is done cutting rates, and just the mix of data releases over the last week or so, we saw quite an upside surprise in June employment data, with the unemployment rate actually ticking lower to 6.9%. So the mix of that with the upside or more mixed, really, inflation data that we're seeing today are quite inducive to our call, essentially, for the Bank of Canada to be on hold. And I think outside of these economic data releases and what they are implying for the Bank of Canada decisions moving forward, there's also the broad question of, just how much can additional rate cuts from the Bank of Canada really help those businesses that are struggling to keep their bottom line